This is Nightly Business Report with Bill Griffith and Sue Herrera.
Death of a giant. Vanguard founder Jack Bogle, who revolutionized investing, has died at the age of 89.
Banking on it, the big banks power higher, pulling in record profits in 2018, adding steam to the recent market rally.
At a crossroads, the markets have moved sharply higher in a short amount of time. But how fast is too fast? And what happens next? Those stories and much more tonight on Nightly Business Report for Wednesday, January 16th.
And we do bid you a good evening, everybody. We begin tonight with some sad news. Jack Bogle, the founder of Vanguard, has passed away. He, of course, was a giant in the investing world. He revolutionized how Americans save for retirement with low-cost, low-fee mutual funds tied to the market indexes. He helped the small investor build wealth and railed against Wall Street's excesses. Tyler Matheson takes a look at the life of a legend.
Indexing always works best, up, down, or sideways.
In 1975, Jack Bogle started the Vanguard Group, and with it, a new way of investing.
Jack was the creator, effectively, of the index funds.
Index funds, mutual funds whose portfolios match a market barometer like the S&P 500, are commonplace today. But they were unheard of in the 1970s, much less the early 1950s, when Bogle wrote his senior thesis about the concept at Princeton.
I said mutual funds should be operated in the most honest, efficient, and economical way possible. I had a sentence in my thesis that said mutual funds can make no claim to superiority over the market averages.
Bogle's thesis research laid the groundwork for what would become one of the most powerful investing movements of the late 20th century. He concluded that active trading mutual fund managers failed as a group to outperform the relevant indexes, especially when you subtract fees and expenses.
Anybody can do it for a year, and a few can do it for 5 years, and a few can do it for 10 years. But over an investment lifetime, there's about a 3% chance that a money manager can beat the market.
After Princeton, Bogle went to work for Wellington Management for over 2 decades, eventually becoming CEO. He was later terminated for what he called an unwise merger. So he started over, putting the indexing concepts from his thesis into practice at Vanguard.
Investors suddenly found the playing field more level. So to a certain extent, in fact, to a great extent, I would say, he democratized investing for individuals, which was a huge contribution in the mutual fund space.
That initial fund, called the First Index Investment Trust and later renamed the Vanguard 500 Index, tracked the S&P 500. Skeptics ridiculed it as Bogle's folly. But by 1990, index investing had taken root. The reason? Bogle turned out to be right. In the 15 years ending in January 2017, 9 out of 10 actively managed large-cap mutual funds underperformed Vanguard's 500 index. Today, Vanguard has more than $5 trillion under management.
Jack Bogle is pretty much like a T-Rex in terms of what Vanguard is versus, a little tiny lizard over here. You don't see too many folks anywhere in the world that manage that much money.
After retiring from Vanguard in 1999, Bogle started a research center on the Vanguard campus. There, he continued advocating for indexing and buy and hold long-term investing. He called trading stocks a loser's game.
It comes right out of Shakespeare. These moves in the market are like a tale told by an idiot, full of sound and fury, signifying nothing. I think it's speculators speculating on what other speculators are speculating on.
And speaking of speculation, few would have bet on Vanguard back in 1975. Even fewer still would have thought Bogle would still be jousting with critics deep into the second decade of the 21st century. He had his first heart attack at age 31. Doctors said he wouldn't make it to 40, much less live to 89. He had 5 more heart attacks before undergoing a heart transplant at the age of 65.
Well, I may be, I don't want to get carried away here, the luckiest guy in the world.
And he will be missed. We turn now to the day on Wall Street, and it was all about the banks. The sector was one of the worst performers last year, but today it saw some new strength. And for that, you can thank Dow component Goldman Sachs, which reported solid earnings results, and its stock posted its biggest gain in a decade. Goldman's quarter was driven by its investment banking and lending divisions, offsetting weakness in trading revenue. It was the company's first quarter with CEO David Solomon at the helm, and he said the future looks bright as well.
For now, the absolute level of activity in the real economy remains fairly robust, and this is reflected in broad CEO sentiment and our investment banking transaction backlog.
Goldman wasn't the only earnings report that lifted the mood on Wall Street. Bank of America also had a solid quarter, the result of lower taxes and rising interest rates, which allow banks to charge more for loans. Goldman Sachs soared 9.5%. Bank of America gained 7%. And those moves lifted the sector, which is one of the biggest, and in turn, the broader market. The Dow rose 141 points to 24,207. The Nasdaq added 10, and the S&P 500 was up 5.
And now that most of the banks have reported they have done something never done before, they turned in more than $100 billion in profits last year. And that number could grow even more after Morgan Stanley reports its earnings tomorrow. A look at the financial ETF exchange-traded fund shows that the sector is up 11% since December 24th, outperforming the broader market.
So let's turn now to David Dietz to talk more about the banks. We had him on the program last Friday to share his fourth quarter earnings predictions, and he's back tonight to see how things have fared. He is the chief investment strategist at Point View Wealth Management. David, welcome back. It's great to see you.
Good to see you.
A quick thought, if you will, on Jack Bogle before we go into the banks.
So Jack Bogle, I never forget his lessons. I think it's really threefold. One is keep expenses down. It's not what you make, but what you make after expenses. Second is you're unlikely to be able to outtrade the market. The market is very efficient. Think twice before you think you have a better idea than the rest of the crowd. Mm-hmm. And finally, of course, is your broker's not always your friend. And always realize that when dealing with Wall Street.
He was one of a kind. We're going to miss him terribly. The banks, they've done very well with these reports for the most part, which you were expecting. Let's review a couple of them here. Bank of America, a big number there, and that was about what you were looking for.
Absolutely. Bank of America is my favorite pick for 2019. And what I like is Brian Moynihan is coming into his own. Remember, he came into a situation where they were going in all the wrong directions with ill-fated merger with Countrywide, ill-fated with Merrill Lynch at the wrong time. And now what is he doing? He's getting costs down. He's introducing technology. He's closing branches where that's necessary and avoiding exotic products. That was shown with a double-digit return on equity. How many money managers in the country got double-digit return on their portfolios last year?
You know, we're also looking internationally and at a more diverse business. Goldman Sachs also outperformed.
Yeah. I mean, Goldman Sachs, I love the start that David Solomon has gotten here. And he's been dealt a tough deck of cards here because he's walking into that Malaysian litigation. But nevertheless, they were able to outperform in merger advisory work, even though they had tough results in trading. They bought back shares, which helped, of course. And at the end of the day, made some strategic cost cutting, including cutting the bonus pool for traders. That really helped them.
A surprising stumble for J.P. Morgan. Now, you were seeing that last week as a proxy for the global market, given their footprint. What did you make of their report?
Well, so, I don't think it was bad, but I think traders were a little nervous about, quite frankly, Jamie Dimon's outlook. He was a little more cautious on what he saw going forward, given the shutdown with the government and other issues, trade issues and so forth. I think that took people back a little bit. And, of course, they have been the leader. They were the top performer among banks last year. Expectations were higher. They didn't beat those higher expectations.
Now, if the Fed does stand pat on interest rates, what does that do to the profitability of some of these banks like the B of A? And, because those higher interest rates help their bottom line. Yeah,
so that's the key question, because on the one hand, the higher interest rates allow them to charge more for their loans. On the other hand, the high interest rates reduce the demand for loans. And of course, the key weakness in all these banks was the housing market. There's less turnover in housing, and people can't afford the higher mortgage. So I think if interest rates stay pat, they're going to see a little pickup in real estate. That's going to help them.
David Dietz, thanks so much for coming back and joining us.
My pleasure.
David Dietz. Bill?
Well, the rally in the banking sector comes at a critical time for the market. A rough December has turned into a much smoother January, of course, but has the rally moved too far, too fast? Mike Santoli digs into that for us.
The stock market has turned a sharp corner with its furious three-week rally, which has quickly brought the major indexes to a crucial crossroads. The S&P 500 has regained close to half of its 20% drop from September into late December, an impressive comeback by any standard. It's been fueled by a rush of bargain hunting and depressed stocks in the new year, combined with expectations of a pause in Federal Reserve rate hikes. Yet the rebound has simply taken the S&P to a level that defined the lower end of its trading range that held for most of 2018. And market strategists view this as a fairly likely area where the rally might stall or pull back. An index level that used to serve as a floor often becomes a ceiling for a time when it's approached from below. The decline from September to December was steep and damaging enough for the market to require time and perhaps some choppy sideways action at least before a proper base is built for stocks, according to standard Wall Street wisdom. Which direction the market takes at this crossroads will have something to do with how the rest of corporate earnings season proceeds relative to reduced growth expectations. Bank results have been good enough to boost deeply depressed financial stocks so far, though they will remain lower than they were in early December. The market's overall valuation has come down quite a bit in the last year, with struggling indexes combining with a 20% surge in profits to compress the price-earnings ratio on expected profits to 15 from 18. But the recent rally hasn't freed investors from the familiar questions that restrained the market late last year. How much life is left in this economic expansion? Will the Fed tighten policy too much? And is there a path out of the trade war before global growth weakens further? For Nightly Business Report, I'm Mike Santoli.
So what is next for stocks? Joining us tonight, back with us, Art Hogan. He's the chief market strategist at National Securities. And we have to start, Art. Of course, everybody's going to be telling stories about Jack Bogle over the next several days as we remember this giant, not only of Wall Street, but of just life in general. Any memories you have?
Yeah, I just remember the one time that I got to talk to Jack Bogle, and one of the things I remember in the conversation when he said that the stock market's a great distraction in the business of investing, and I've always taken that to heart. And he was the first person that really got around to people to say you need to get rid of some of that noise and think about the long term and the buy and the hold. He did more for individual investors than I think any man that ever lived, and very sad day to see him go, but it's just amazing how much he has changed our industry over the 50 years that he was in it.
Yeah, absolutely. You know, Art, you've changed your focus a little bit, or not your focus, but your targets a little bit for this market because of three main events or headlines that have been out there. And one of them is the government shutdown, correct?
Correct, yeah. And I think that, it's interesting, Sue. The government shutdown very much a political event, but the longer it lasts, it becomes an economic event. So I don't think we're at a point where we can actually, tell you how much it's going to take out of first quarter GDP, but we certainly know it's something. And I think the longer it drags on, the more that becomes. And I think at the same time, you've got a global economic slowdown. A lot of that caused by, concerns over a trade war with China. So the longer that takes to resolve, the more economic damage that does. So, I think we see a slowing global economy, and we know some of those causes, and we have to ratchet back some of our expectations for earnings for the S&P 500 because of that. So I know we've come in. We still have an upside to where we are now, but certainly not as much as we expected in the first half of last year.
We've had a pretty good snapback rally since Christmas Eve after a pretty dismal December, but there seems to be still a lot of skepticism about this rally that it may not last. Do you think because of these headwinds you just itemized, that's why people are looking at this a bit skeptically?
I think that's it. I think when you think about where we are, we're about back to neutral, right? So we're an S&P 500 that's trading about 15 times forward earnings, and that's about average. We're 10% off the highs and 10% off the lows. So we're kind of back in the middle ground, and I think that's exactly where the battle goes on. I think 2,600 on the S&P 500 is exactly where we're going to draw that battle line, and we'll see if earnings can come in better than expected, and we've priced enough bad news in. I think that's one thing. The problem is, with all those uncertainties, guidance for 2019 would have to be lackluster at best. If I'm a CEO, I don't know that I'm going to stick my neck out and say things are great in 19 unless and until we get some resolution on things like the government shutdown, Brexit, and the trade war with China.
On that note, Art, thank you, as always. Art Hogan with National Securities.
Also helping sentiment today on Wall Street was China. That country's central bank injected a record $83 billion into the country's financial system, a move designed to shore up liquidity in the world's second largest economy. And it's all part of a wider stimulus plan, which strategists say may also include tax cuts and an increase in government spending. Separately, the Wall Street Journal is reporting that the Justice Department is pursuing a criminal case against Huawei for alleged theft of trade secrets.
In the United Kingdom, Prime Minister Theresa May survived a no-confidence vote, but not by much. And it comes just a day after UK lawmakers rejected her Brexit proposal in a historic parliamentary defeat. Willem Marx reports tonight from London.
Theresa May has now spent 918 days resident at number 10 Downing Street. That will soon become 919 after this evening's narrow political escape.
The ayes to the right, 306. The noes to the left, 325.
This attempt to topple May's government was an almost inevitable consequence of yesterday's crushing defeat, when scores of her own Conservative MPs voted alongside their political opponents to repudiate the withdrawal agreement the Prime Minister's team had negotiated with Europe. This evening's marginal victory was only possible thanks to what's known as a confidence and supply deal with a small Northern Irish party, the Democratic Unionists. Without their 10 votes, May would have lost. May promptly promised to meet with her political enemies to discuss what could constitute a Brexit consensus.
I would like to invite the leaders of parliamentary parties to meet with me individually, and I would like to start these meetings tonight. Mr. Speaker, the government approaches these meetings in a constructive spirit, and I urge others to do the same.
Her opponents immediately insisted they would only attend such meetings with strings attached. The Prime Minister has always insisted the threat of no deal is necessary leverage for any negotiation with Brussels. But Labour leader Jeremy Corbyn said talks could not continue if that option remained on the table.
The government must remove clearly, once and for all, the prospect of the catastrophe of a no-deal Brexit from the EU and all the chaos that would come as a result of that.
May's chief Scottish critic in Westminster, Ian Blackford of the Scottish National Party, laid out several obligatory options.
The only way forward is to extend Article 50 and ask the people of Scotland and of the United Kingdom whether they want the Prime Minister's deal or whether they want to remain in the European Union.
The British Prime Minister has, if nothing else, at least won a few days of breathing space, at least until Monday, when she should return to the House of Commons with a workable Plan B that could command a majority amongst lawmakers. For Nightly Business Report, I'm Willem Marx in London.
Time to take a look now at some of today's upgrades and downgrades. We begin with shares of Nordstrom. They were downgraded to neutral from buy at Goldman Sachs, with the analyst saying that the retailer is not selling as much merchandise at full price. And in fact, last night, Nordstrom did warn of soft holiday sales. Price target now $50. That stock fell more than 4.5% today to $45.01. AB InBev was downgraded to underperform from hold at Jefferies. The analyst says that market sales pressure will likely persist, which could lead to disappointing earnings. And that price target is now $62. The maker of Bud and Bud Light fell more than 2.5% to $70.50. Meanwhile, MetLife was upgraded to buy from neutral at Bank of America Merrill Lynch. The analyst cited management's strategy to address past issues. Price target $53. That stock rose in trading today to $44.87.
Still ahead, the parts of the country where economic concerns are mounting. Home builders started the new year in a better mood. According to the National Association of Home Builders, sentiment rose in January, rebounding from a 3-year low. The report cites a decline in mortgage rates in recent weeks and solid job growth. Monthly housing starts and builder permits will not be released tomorrow due to the partial government shutdown.
But a new survey from the Federal Reserve shows a decline in economic optimism in some districts and growing concerns. Steve Leisman has the details from Washington for us.
The Federal Reserve's Beige Book, the collection of economic anecdotes from around the Federal Reserve's 12 districts, saw 8 of 12 districts reporting increased growth at a modest to moderate pace, but 4 districts, Kansas City, New York, St. Louis, and Cleveland, saw less robust growth. In fact, growth was flat in Kansas City and leveled off in New York. The outlook remained generally positive, but many districts said their contacts grew less optimistic for 4 particular reasons: because of the financial market volatility, rising interest rates, falling energy prices also hurting optimism, as well as elevated trade and political uncertainty. The shutdown was only mentioned by the Chicago district related to farmers not receiving government payments, but only a small part of the shutdown was covered by this Beige Book so far. There were several mentions of tariffs linked to rising uncertainty and higher input prices. Some companies, however, were able to pass along those higher tariff prices to consumers. Several districts said Christmas sales were pretty good, but auto sales were flat. Manufacturing expanded in most of the districts, but slower growth was reported. Services growth slowed in a few districts, and the agricultural sector struggled with lower prices. The Beige Book reported a pretty rosy picture for employment, with jobs growing in several districts. Labor markets were to be tight, and business contacts said they had trouble finding staffers. There was even some labor hoarding going on in Atlanta, with extra workers hired than were needed. Modest wage gains were reported throughout the country, though entry-level wages were rising. Despite those higher wages, prices throughout the economy increased only modestly. There were some higher input costs by businesses, but they had trouble passing along those higher prices to consumers. Overall, this was a mixed report showing that growth was still continuing in the country, but at a slower pace. For Nightly Business Report, I'm Steve Leisman in Washington.
A mega deal in the fast-growing financial tech industry. That's where we begin tonight's market focus. Fiserv is buying First Data in a takeover valued at $22 billion, making it one of the largest in the sector. Fiserv sells systems to financial firms, including those related to electronic payment transactions. First Data offers point-of-sale products for retailers. First Data soared 21% to $21.24. Fiserv fell 3% to $72.57. BlackRock reported quarterly earnings that missed analysts' expectations. The world's largest asset manager saw its assets under management decline, but that was primarily due to the drop in the market late last year. BlackRock did report record ETF inflows in the quarter of more than $80 billion, and the shares rose 3% to $413.04. And Ford says fourth quarter profit won't be as strong as Wall Street had hoped. The automaker cited lingering uncertainty, including trade and Britain's exit from the EU. But Ford added that it has the potential to grow earnings this year. Nonetheless, shares fell 6% to $8.29. Snap's chief financial officer unexpectedly resigned less than 1 year into the job. In an SEC filing, he said his decision has nothing to do with matters related to accounting or management operations. But his exit is the latest in a string of other executive departures. Shares dropped 13% to $5.64.
U.S. Bancorp's fourth quarter profit rose by 10%. Its results were helped by higher interest rates, lower expenses, and an increase in loan activity. Revenue also rose compared to last year. The stock was up more than 2% today to $49.11. Charles Schwab reported better than expected earnings and profit as well, with the brokerage's results helped by gains in trading activity, as well as record asset inflows across both its retail and advisory service businesses. Shares gained about 5.5% today to $46.70. And railroad operator CSX reported quarterly profits that topped Wall Street expectations. The company cited an increase in shipment and higher prices for transporting freight that helped offset higher expenses. Shares initially fell in extended session today, but CSX finished the regular day up a fraction at $65.38. Coming up, an American icon gets a second life. Here's a look at what we're watching for tomorrow. Financial sector earnings continue with American Express and with Morgan Stanley. Netflix reports its quarterly results just days after increasing prices on its streaming services. Economic data will focus on the labor market with the release of jobless claims. Should be interesting. That's what's coming up tomorrow.
Incredibly, it looks like Sears will stay open. According to multiple reports, the retailer's chairman, Eddie Lampert, won a bankruptcy auction after sweetening his offer twice to more than $5 billion. Lampert's last-ditch plan must first be approved by a bankruptcy judge, and if approved, it would keep about 400 stores open. But the company's not out of the woods yet. There are reports that some creditors still object to Lampert's plan and would prefer a total liquidation of the retailer.
The Department of Agriculture is recalling workers to temporarily reopen an agency that provides services to farmers and ranchers. About 2,500 Farm Service Agency workers have been called back to work without pay, by the way, to process existing farm loans and to provide tax documents. The office will not process new applications for trade aid payments, by the way.
And before we go, here's a look at the final numbers from Wall Street. The Dow advanced 141 points, the Nasdaq added 10, and the S&P 500 was up 5. And that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. R.I.P. Mr. B. We'll see you tomorrow.